Good morning. Today is Wednesday, October 14th, 2020, and thank you for joining us for another edition of the Market Commentators podcast. My name is Andy Willms. I'm the president and CEO of the Milwaukee Company, and for a little change of pace, joining me this morning is Jake Willms, who is a quantitative analyst for the Milwaukee Company. Welcome, Jake.
Hey, thanks for having me. Been working behind the scenes, so nice to be on the podcast for a change.
Yeah, Jake, we were promoted to executive editor last week, and executive editor and co-host this week. So great to have you with me, son. For those of you who don't know, Jake is my son. Jake joined the Milwaukee Company a few months ago after finishing his second master's degree in quantitative finance. And Jake does a lot of the coding and strategy and testing that we do here at the Milwaukee Company. As you know, all of our strategies are rules-based by and large, so we can actually back test them, and that requires developing computer code to run the back tests, and that's where Jake comes in. So
a lot of numbers and computers is on my end for my job description, that's for sure.
Yeah. Exactly. And before we get started, Jake, I want to give our audience a quick reminder that nothing in this podcast should be construed as investment advice, and that the views we're going to be expressing represent my and Jake's personal views and not those of the Milwaukee Company.
So, Dad, I know you like to start each podcast with an update on what has occurred in the market since the last podcast. So could you bring our listeners up to date?
Sure, I'd be glad to. Last week was a good week for the markets. The S&P and NASDAQ rose 3.8% and 4.6% respectively, and posted their best weekly performance since July. And the Dow Jones Industrial Average, while trailing by a small amount, managed to rise over 3%, over 3.3% for its best weekly gain since August. The driver for those gains, it seems, was optimism over the possibility of another stimulus package being passed before the election, but that optimism has largely faded over the weekend, with Nancy Pelosi expressing criticism for the latest offer from the Republican and Trump administration as being one step forward and two steps back. So, and even the Republicans thought Trump's proposal was too expensive. So it doesn't look to me like we're going to get much in the way of a stimulus package before the election. And this week, Congress has really been focused on the Judge Barrett Supreme Court nomination, which has been rather fascinating. Unfortunately, work keeps me from watching it, but from as I've heard, the whole proceedings have been much more civil than they have in the past, and I think that's a good thing all in all for our country.
The Supreme Court nomination has been a topic of interest, especially among the younger generation on social media. People have been very engaged in discussing that topic and whether or not the nomination should happen. So I'm interested, especially to see how that plays out.
In terms of what's been driving the market, it's been the so-called FANG stocks, Facebook, Apple, Amazon, Microsoft, and Google. They've all been really pushing the market higher, and that was especially true on Monday, where Apple jumped 6.4% as investors are eagerly awaited the company's unveiling of its first 5G iPhone. Jake, have you got your order in?
I was thinking about it. It's a little expensive, so I may have to wait a little bit, but it looks really cool. I definitely did have that broadcast on my second screen at work yesterday, paying attention, just keeping track of what they've been up to. Any of the tech industry is just good to monitor, especially because of how prominent they are with leading indices. So,
yeah, on Monday was a good day for Alphabet. It was up. That's Google's parent. It was up 4% because Deutsche Bank hiked its price target on it, and then Facebook and Amazon. Facebook was up 4%, and Amazon was up 4%, and Microsoft gained 2.6%. So they all continue to drag the market forward, but the major averages were lower on Tuesday amid concerns about the fiscal stimulus not going through and halts to recent coronavirus vaccine tests and treatment programs, which we'll talk a little bit about as we go forward.
Why don't we switch gears and talk about what's new on the economic front? Because that's a totally different landscape for sure.
Yeah, and there, it seems to me that outside of the whole COVID situation, which is continue to be the biggest driver for both the market and the economy, I think interest rates are where people might want to be focusing in terms of economic data. The spread between the 30-year and 5-year Treasury yields, that so-called yield curve, steepened or rose to 127 basis points last week. That was the largest level since November of 2016, and only 25 basis points back in July of 2018. It's been rising ever since then. So we're seeing yield curves widening significantly, and we're seeing signs that inflation might be, there's thoughts that inflation could be rising as well, and that's part of the reason for the spread in the yield curve. Now, last month, the September, seasonally adjusted prices for the consumer price index only rose about 0.2%, which is pretty consistent with expectations, but it did mark the fourth straight month of gains, although it was a smaller increase than we saw in June, July, or August. Another big area of concern, and it has a major impact on interest rates and inflation itself, is the U.S. budget deficit. And it tripled in the fiscal year ending September 30th. Congressional Budget Office reported on Thursday. And that's, largely due to the government battled pandemic, as they continue to do all this stimulus spending. And the CARES Act has added significantly to the budget as of late. So those indicators would suggest to you that we might be looking at higher rates of inflation.
Very interesting. I'm very curious to see about how that yield curve changes moving forward. I know interest rates are expected to remain low in the short term, but that fact that it's been steepening recently is kind of a surprise to me. Yeah. I wanted to touch on the coronavirus a little bit more. So as of Tuesday, pretty much every major metric for the coronavirus is unfortunately rising. New U.S. COVID cases have been reported at 46,647. Daily new testing reported is over 1 million, and new patients in the hospital is over 36,000 now. So all of these are rising. Just another example of how coronavirus is seeming to hit a second wave, and the country is just struggling at large to keep this under control. Also, I was going to talk about Johnson & Johnson, one of the late-stage leading coronavirus vaccine developers, had incurred a pause earlier this week after a reported adverse event illness occurred from one of their trials. And now it may seem like a big deal, and that's like a problem, but pauses are pretty typical throughout the life cycle of a vaccine development stage. So unfortunate slight development halt, but this is normal. So it's not something to read into too heavily and freak out over, I would say, but it is a delay in progress, that's for sure. Any adverse event is not something to celebrate.
And Eli Lilly had to pause theirs too. That just came out this morning. At least I just heard about it this morning. And so, because of a potential safety concern. But you might remember, Jake, back in September, on September 8th, AstraZeneca had to pause its trial due to unexplained illness in the United Kingdom, and they've since resumed.
Yes.
So I think you've hit the nail on the head there, son. These pauses are concerning, but the market hasn't read a whole lot into it. You've seen the stocks of the individual companies suffer a bit, but the market as a whole took these pauses in stride, it seems to me.
Yeah, the market has been taking the coronavirus in stride quite a bit lately. The tech industry, I think, is doing a heroic effort of carrying these major indexes forward throughout this uncertainty.
Yeah.
So I wanted to transition us to the usual roundtable discussion period of the podcast. And the first topic that I have for you is regarding interest rates. I know we touched on it a little bit with the economic update before, but specifically I want to talk about bond yields. These are a rise when bond prices fall, and they have climbed in recent days, as we talked about earlier. Polls are also showing a growing lead for former Vice President Joe Biden in the upcoming presidential election. and the chances of a Democrat win across the board could be improving as well. So I want to ask you, how do you think these upcoming election projections, specifically a Democrat-led projection, affects interest rates moving forward?
Well, I think whenever you have a sweep, whenever you have one party that controls, both the House and the Senate, and then again also the White House, you run the risk of higher deficits. And you may remember 4 years ago when the Republicans captured the Congress and the White House in 2016. That before the election, the 10-year stood at about 1.9%, and it quickly rose to 2.6% after the Republican sweep. And it really, to me, it's not whether Biden or Trump wins; it's whether one party controls all unified government, because that makes it easier either for the federal deficit to grow, either through tax cuts when the Republicans have control, or spending programs when the Democrats have control. Either way, bigger deficits can push yields higher for two reasons. The first is that when you increase the supply of outstanding bonds as the government ramps up borrowing, that of course that increase in supply affects price. Yields are going to drop yields are going to have to rise as supply increases. And secondly, the potential boosting of economic growth and inflation makes, that usually comes with government spending, makes bonds less attractive to stocks compared to stocks, which also requires, so investors insist on a higher interest rate in order to attract them. And so, there's several people who have commented that if there is a sweep, that, the 10-year yield could easily go to 1.3% in the short term. Now, that all being said, I think it's very important to keep in mind that there have been a number of other events that would maybe override or take precedence over the outcome of the election, such as the development of a vaccine or market slowdown in the economic recovery, all those types of things. But if the election itself is the driving force between what happens in the markets, then I think you'll see interest rates rise if you have a Democratic sweep.
Yeah, that's a good point. I think a lot of times people can get sort of wrapped up in the opinions of what a Democrat or Republican-led Congress and presidential House can kind of mean in terms of markets, but I like that you presented it as it kind of irrelevant. Either way, we should expect bigger deficit spending if there is a sweep.
You could see bigger deficit spending even if there is a divided House, because right now, the biggest thing that's holding up the stimulus package in my mind is the politics involved. The Democrats don't want to give President Trump a win right before the election, right?
So, yeah, that's true.
And this is not. I'm not necessarily faulting the Democrats. I'm sure. I strongly suspect that if the roles were reversed and President Obama was still in office, that the Republicans would be dragging their feet on a stimulus package in order to avoid giving him a win. So.
Right.
Either way, there probably will be, in my mind, a stimulus bill that will come out after the election. I think you will see deficits growing even faster, and as a result, I think, I think there's a greater risk of the yield curve widening and inflation taking hold. Not that I'm predicting it, but I think the odds of it are going up after the election, regardless of how it turns out. And if the Democrats sweep, I think the odds are significantly greater that we'll see.
So now let me follow up with a question. If you and I both agree that the stimulus deal is political by nature,
yeah,
and the Democrats may not want to give the Republicans and Donald Trump a win right before the presidential election,
right?
Do you think that it would be delayed further should President Trump lose? Because if that were to be the case, I think political divided nature could still remain, whereas if he would win and it was confirmed that he was going to be staying for another 4 years, they may be inclined to negotiate.
That's a good point. I think that if Biden wins though, and the Democrats remain in control of the House, that there's going to be a realization that Biden's going to be there for 4 years, and I think ultimately that we'll probably see a stimulus package passed, but it'll just be a smaller one that would be passed if they control both the House and the Senate. That would be my thinking.
So
Okay.
let's switch bases here. The next topic I wanted to touch base on would be the earnings week.
Mm-hmm.
So this is a big week. It's quarter three. The release of the earning reports are coming out. We're midweek here, so we're going to be expecting things from JP Morgan, Citigroup, Goldman Sachs, major banks, and financial institutions. These earnings could provide positive momentum for stocks if companies can continue to beat estimates at a healthy pace like last quarter.
Right.
So the simple question is, what do you think investors should be expecting to hear?
Well, we've heard some. We heard from some of the banks already, and they've done remarkably well, much better than I would have anticipated. If you had told me, a year ago that there was going to be the coronavirus and all this was going to impact and interest rates were going to be so very low, I would not have expected banks to do as well as they have. But I wouldn't have expected for the stock market to do as well as it's done. And the rising stock market has allowed banks to do very well. It continues to provide them with their trading business, very large profits. So that's offset the money that they would normally have made in their lending arm. And the other thing that banks have experienced is a much better. They have had many fewer defaults than they were expecting, and so their bad debt reserves have not been tapped like they expected. These banks have reserved billions of dollars for bad debt, and they haven't needed it. And I think that's primarily done due to two things. First of all, there's been a lot of forbearance. The idea being that, well, we won't put you in default if you don't pay on time. We'll defer payments until the coronavirus is behind us. And because the government has pumped so much money into the economy, there's more money floating around, and businesses that would have otherwise failed have been able to stay afloat. So the banks, I think, I think the earnings season might turn out to be better than expected based on these early reports. And the guidance, too, looks pretty good.
That,
Go ahead.
that's pretty surprising to hear, especially since that in recent history, banks haven't done quite so well in circumstances such as the ones that we're in right now,
Right.
with lowered interest rates and a recessionary market condition.
Right.
So
But
I'm
it's
hopeful
really
that we're going
driven
to continue
by
to
the
see
rise.
good performance from the financial sector at large. But I would say that this is just another example of how atypical 2020 has been in every facet of our lives, from finance to
Yeah,
health, everything.
yeah. I think it would have been virtually impossible to predict how this all would have played out. And this is one area where I think that's particularly true. I think it's also interesting, Jake, that analysts have recently upgraded their expectations for earnings across the S&P 500 companies. But so that's a positive. But we still expect them to be. They're still expected to be down about 20% over last year, according to data that I saw on FactSet.
Mm.
But you'd say, wow, 20%, that's really bad. But the forecast a few months ago was down 31.6%. So, and that's a pretty significant improvement. That's an improvement of about a third, so I guess a little over a third. We talked about financials. They've been one of the worst performing sectors this year. They've dropped about 18%
Right.
through last Friday's close. And we've talked about the fact that there's been much lower, that they've been, I think we'll see them do a little bit better here because of their much smaller than expected loan loss provisions. And I think we're seeing that the banks are getting more confident, which I think is important takeaway, that banks appear to be getting more confident that the pandemic won't send the economy into this huge slide, even if they see a long path back to growth. So I think that's all positive.
All right. Well, we will hopefully wait and see, expecting good things from the financial sector this quarter. I got one more topic for you today. This one is one I have personal interest in. We're going to be talking about the FANG stocks.
Yeah.
The House antitrust report has hit Apple, Amazon, Facebook, and Google, and they have been proposing a very interesting breakup, suggesting that these companies are too large. They put out a 450-page report arguing that they should be broken up and separated.
Yep.
For being too strong.
Yep.
Now, I know that this has happened a long time ago and haven't had any sort of situation quite like that since today, but over the last 20 years, with the rise of the technology sector influencing our lives in such a pronounced way, and the fact that, as we let in at the beginning, these stocks have been so influential over market conditions in major indices and propelling the stock market at large.
Right.
So with that being said, do you think they've actually gotten too big and the Democrats have a good point here?
Well, I'll tell you, the idea is that, typically when you had companies get the concern expressed when companies got too big is that they had a monopoly. And that's why we have antitrust legislation. And but everything I learned in law school would tell me that many years ago, I will say, but that there's really nothing, very scant evidence of the historical elements needed for an antitrust violation. There's really nothing that's occurred here with these companies that would suggest they are in violation of the antitrust laws. So lawmakers don't like them to get this big, so they're pushing back and saying, well, then we have to overhaul the antitrust laws. And, you mentioned that 450-page report. I will confess I did not read it, but the synopsis that I've read, basically sounds to me like what they're doing is blaming these companies for making products that people want to use and improving those products based on market trends and consumer research, and engaging in activity which I learned in business school was very normal business practices, such as Amazon wanting to prioritize the display of its own products on its own website, or for Apple, criticizing Apple for choosing what products it wants to sell in its own store. Those seem to be kind of unusual criticisms. But what's most unusual about the whole thing to me is, and I admit I'm sort of a free markets kind of guy. That's where my but it's really perplexing to me that the House would choose to do this in the midst of a pandemic, where the very companies they're attacking have been so essential to allow the U.S. economy to stay in function, and for and made such a huge improvement in people's lives. I mean, can you imagine how bad this pandemic would be if we didn't have Amazon bringing goods to our house?
Seriously.
Or if you didn't have all the Apple, or you didn't have Apple Play or Google, or these companies have been instrumental in getting us through this virus with as little pain as possible, and yet
that's definitely true. However, that does bring me some concern about if that gives them an unfair position of strength. They've grown to this colossal level, whether it be from fair play or not. I think that it is at least a little concerning how large that they've become, and the power that they hold over the economy at large. As you just discussed, these four companies were considered essential for this recovery path that we're still heading towards right now.
Right. And, they said the same thing about Microsoft 10, 15, maybe even 20 years ago. And they were going to break up Microsoft. They said Microsoft has gotten too big. We've got to break it up. It's dominating the entire internet. There's nobody who can compete with them. They're going to be controlling the entire internet in no time. And what happened? People out there, there are advancements that come into effect. And through those advancements, they raise competition. And we see it today, right? We see Walmart doing a better job actually than Amazon has been in dealing with the getting people goods and services during the coronavirus pandemic. So you have an old brick and mortar store that's adopting Amazon's concept and using it to compete against them very effectively. So I think innovation is what will keep these companies from getting way too big, and bigger where they start to cause problems. And I think that if Amazon wasn't as big as it is, there wouldn't be next day delivery possible. Right? There's a lot of things they can do because of their size that have been essential to us in this whole pandemic that they wouldn't be able to do if they weren't as big as they are.
Yeah, that's a really good point. Also, I think another thing to consider here is that, which is I would say this is atypical for antitrust investigations. We're dealing with actually like a couple of companies all at the same time. Like you mentioned Microsoft back at the beginning of the 21st century, where they were being looked at for antitrust, and I believe that they settled with the government on that. But
Right.
We're dealing with people that actually compete directly with themselves. Google and Facebook, Apple, they all are competitors.
Right.
Maybe their products aren't the same, but they really do share a lot of common ground fighting for competition, especially Apple and Google, a lot of their consumer products. So it's
a little like if you can't beat them, outlaw them.
Yeah, it's a little different.
But
I would agree with you that I think that tech breakups are unlikely at this time because there isn't anything alarmingly obvious that would suggest antitrust. But I think it's something to definitely keep in mind and monitor because there's no sign of them slowing down anytime soon.
Well, I agree with you about keeping an eye on it because I do think that if you do have a sweep, going back to our prior discussion, and the Democrats control the House, the Senate, and the presidency, then there'll be a real threat to these companies because then they'll have the political wherewithal to break them up if they so choose. And of course, that will have a major impact on the indexes that have been driven up by these companies like the S&P 500 or the NASDAQ because they're so concentrated in these few names. And so if you share that concern, you may very well want to reconsider, and I've talked about this last week, whether you're better off with an equal weighted version of the S&P 500 or an equal weighted version of the NASDAQ 100 so that you're not so heavily invested in these companies that face this threat should there be a blue wave.
Yeah, I think that's a really good point too.
Oh, thank you. Well, son, it's been a pleasure having you on our podcast this morning. I see the time flies when you're having fun. We've already run to the end of the podcast, so I'm going to wrap it up by thanking our audience for joining us today and to reminding them to please keep in mind that you should not act on anything you've heard in this podcast until you discussed it with a qualified financial professional who's familiar with your situation, your investment objectives, and thank you, Jake, for joining us.
Yeah, pleasure. It's mine. Thank you for having me on. It's been fun.
Maybe we can have you do this again. What do you say?
Wouldn't be opposed.
Okay, great. All right. Well, have a great day, everybody. And once again, thank you.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.